I'm diving into something I never really thought I would get into. We're going to talk about ETFs, crypto, and commodities. Heck of a combo, isn't it? Uh, you get guest pitches a lot. This one, I was very curious to see how things are drawn together. And we're going to find out how there's a little bit of a connection. And just the overall investing picture as a whole, signs, signals, trends, buying dips. Who's paying attention to commodities? Hint, it's not just those who are in the cornfields or in the soybean fields raising and growing it. Others are paying attention. Others are interested. And yes, we're going to talk the S word, speculators. You love them, you hate them. We're going to talk about what they mean to the commodity markets. That's just part of the conversation. That's not the whole thing. Jake Hanley is with Tucrium, and he is based in Vermont, but he's spent time in Connecticut and, of course, New York and the East Coast. We're going to talk about why in an area that doesn't grow corn and beans and wheat, they're caring about corn, beans, and wheat. And what's their perspective from that spot? So we're going to talk about the diversification in investment portfolios, liquidity, and what that means to the markets, government reports, what's the gold standard, and what does that mean for you? That's this installment of the MTOM podcast. I'm Paul Yeager. Glad to have you here. New episodes come out each and every Tuesday. Man, I feel like I'm shouting. I'm not. We'll have a conversation instead with Jake. Jake, Vermont in the fall, is it as beautiful as I think it is?
Oh, absolutely. If you've not been, please come up. It is the tourist season. We're just on the back end of it now. And so living here, it gets busy. Imagine if you had a bunch of tourists coming in through harvest season just to watch those combines roll.
I think we think anybody who rolls through when a combine's trying to go through town is considered tourist when you're trying to move that big machine down the road. So I think we're very familiar with it. We did have a reporter come out years ago for a story about the maple syrup industry. We know that is still a big thing there. And there's got to be more to Vermont than just maple syrup and tourism. Looking at the leaves, peepers, isn't that what they're called? Yeah.
Leaf peepers, absolutely. Of course there is. We have a large dairy industry here, of course. And, that is huge. It is the milk that goes into Ben & Jerry's ice cream. So we have just as many tourists coming up to see Ben & Jerry's ice cream as they do come to see the leaves, which is wonderful. But, Vermont also has great skiing. Our hockey program is trying to make a comeback at the university level. So, if you like mountains and fresh air and lakes, this is a great place to be, which is why I'm here.
And you have a background financials, Merrill Lynch, and now Tucrium. What's the connection between the two?
Yeah, well, they both have to do with money, and so that's the easy connection. But yeah, I came up as a financial advisor, helping clients build portfolios, helping mom and pop retire. And about 10 years ago, I had a bit of a shift in my life. My wife and I actually grew up in southeastern Connecticut. And when we had our first child, we decided to move up to Vermont and raise a family. And that was a lifestyle decision. And I ended up meeting my colleague, Springer Harris, who works at Tucrium. I met him socially, and he seemed like a really nice guy. And he brought me to his office, and down here on the waterfront in Burlington, he was running a Bloomberg terminal trading corn futures. And I scratched my head. I said, "Who are you? What are you doing?" And I was just fascinated. Always been fascinated by the markets. I hold the chartered market technician designation. And when Springer said they had an opening in the company at Tucrium, I took the opportunity to join. And threw myself into learning about the agricultural markets. Growing up in southeastern Connecticut, there's a lot of talk about stocks and bonds, but not a lot of talk about commodities, as you can imagine.
Well, I guess there's not as many people doing corn futures in Connecticut as you would think, but I know that they are there. So what was the first lesson that you were taught when it came to understanding corn futures?
Oh, boy. Like drinking out of a fire hose. I had to get my Series 3, which is what you need to trade, futures and commodities, and realized I wasn't as good as math as I thought I was as I'm trying to calculate basis. That was always fun doing the basis math. But really, the founder of the firm here, Sal Gilberti, he said, Jake, when you get into something, you're learning it for the first time, you pour it on your Cheerios in the morning. That's how, involved you got to be. And so I found some, great programs, Market to Market. You folks have been wonderful from a learning experience. Pro Farmer has been a great resource. And AgriTalk as well. I listen to AgriTalk Radio. Those guys, Chip Flory does a good job.
Chip Flory. Everybody has a Chip Flory story. Good job, Jake. Way to drop that one in there. Ted Seifert will love that because he's a big fan.
Yeah, there you go. That's for Ted. That's good.
So corn futures is okay, but there's a couple things I want to unpack there. I mean, let's go back to the location.
Sure.
I'm guessing there's not a ton of cornfields around. You are, it sounds like, that other group of people who are interested in the corn market, who aren't necessarily living and breathing it, growing it. Why are you important to the market? Why are you here, Jake? Why?
Yeah, why are we here? So this is a really interesting story. Stepping out into the realms of finance for a moment. There are these vehicles called exchange traded funds, which I'm seeing nodding. Paul, you're familiar with them. They're like a mutual fund for people that don't understand that. But they trade on an exchange, meaning you can buy and sell during the day. Well, in the early aughts, early 2000s, ETFs, exchange traded funds, started to focus on real assets and commodities. The very first oil ETF came to market. And so the nice thing about these ETFs is if you want exposure to futures, you don't necessarily have to open a futures trading account with an FCM. You can buy that exposure through your traditional brokerage account, buying that ETF. And so Sal Gilberti, our founder, was a commercial energy trader. And actually, he wrote the very first ethanol swap contract. So he was very interested in energy, but also in agriculture. And he was looking at the world and he said, well, hold on a second. There's these energy ETFs, oil and natural gas were in the market at the time. He said, but they're nothing for corn, nothing for wheat, nothing for soybeans. And these are huge markets. And so he thought around 2009 that it was a good idea to launch agricultural ETFs. And so that's where we bridge the gap between Wall Street and agriculture here, is we're helping provide that exposure to investors through a simpler solution, be it an exchange traded product where you can purchase through your brokerage account.
How many people are interested in doing that? You don't have to give me the exact number, but I mean, are there people interested in it?
Not as much as we would like. And so, Sal, just say that honestly here, Sal Gilberti, being in the commercial business, just looked at the market, said they're absolutely huge. And he would admit to the fact that he did not see through to the retail level. And when I say retail, I'm talking about those folks that are sitting in the chair where I used to sit as a financial advisor, or even as a person who's trading your own account, to say, I want exposure to corn or wheat or soybeans, and make that connection. Why? How does this help me retire potentially? Right. And so me coming from that world, I've been helping craft that story for folks to understand, well, hey, hold on a second. When you look longer term, we can talk about that, corn, wheat, soybeans, they have very low correlations to stocks and bonds. Their prices happen to zig when stocks or bonds zag, okay? And so there's some diversification benefits potentially to hold these assets in your portfolio longer term. And so that's part of the story we've been telling.
And you're also dancing around the word. It's also a hedge against those other bets too.
It's a hedge against the other bets. It happens to do, historically very well during periods of inflation, and you can see that. Obviously, we can go back to the 70s and 80s, but most recently, of course, 2022, we were dealing with 9% plus CPI, and that calendar year was a time where both stocks and bonds were negative on the year. Commodities were positive, and I probably bring up the year 2022 at this point. People are looking at those days, wishing they were coming back for our farm audience here. But that's the point that we make to investors is, hold on a second. You're looking for the best rate of return you can achieve to meet your objectives while taking the least amount of risk. And there's few things that you can add to your portfolio that are more unique than agricultural commodities. Just the structure of the markets, how there's seasonality involved. Of course, there's, production side is subsidized across the world. And so farmers all over the world plant every year. And there's some marginal, are you going to plant more corn? Are you going to plant more soybeans? But the crop gets in the ground. And so that adds a supply element relative to the demand element that is always growing, right? And you have to point to the WASDE report that just shows that demand over the last 20 years is just unbelievable how demand for these commodities continues to grow.
You mentioned it's like a mutual fund. So then does that make you the funds? The funds are long, the funds are
Yeah.
short. Are
Yeah,
you helping fill in who this funds is?
that's a great question, Paul. So all of our single commodity agricultural ETFs, exchange traded funds, are long only. Okay, so we are never on the short side of the ledger. We are allowing the investor to choose when they want to be in and when they want to be out. So we actually don't give any advice, and we're not taking any speculative position on our own, betting that the price is going to go up or go down. But yes, technically we are in there as the funds. But I like to think about it. So for example, right now, no secret, as we sit here on October 21st, there are some issues for soybean farmers, right? With finding storage and China's not buying beans. Well, I talked to one group recently where they were putting the beans in the bin, but they were looking to sell the carry on the board. So they were selling the March and July soybean contracts. Well, our soybean ETF is long the March contract, March 2026 soybeans. And so if they're selling, that farmer is selling, they're selling into liquidity that is in part, from that soybean long position. Our ticker symbol is SOYB, so I'll call it SOYB. SOYB owns the March 26 contract. And so to the extent that investors want that long exposure, these ETFs exist, and they do provide that long-term hold.
You mentioned a couple of years and things change. What ebbs and flows people into these types of accounts that you're speaking to? I mean, we already kind of said the whole, a hedge against something else, but is there another driver that gets people interested in commodities?
Yeah, I think so. I think what you have to look at is the history of these markets in general, traditionally reserved for sophisticated futures traders. And when you're trading futures, it's usually you're trading momentum. And so what we've seen over the years is investors playing the momentum. So when prices are moving up, they'll get in and try to ride the wave higher. When prices are moving down, they're not afraid to get out either. And if you think of grain commodities on a longer term basis, not necessarily being a day trader, right, but maybe looking at 6, 12, 18-month time frame, so forth. You can think back to a corn chart. Maybe some of the farmers folks listening can picture a 17-year front month futures corn price chart, right? There are these couple of peaks that really jump out to you, most recently 21, 22, and then back in 11 and 12. Mm-hmm. And then you have this trough period, right, basically between 2014 and 2020, where prices more or less move sideways, okay? And what we've identified is, you can look at this going back further than that, is this cycle where grain prices are going to trade at or near their cost of production for an extended period. We call that stage one. Stage two is when there's a production problem or some other type of supply issue that puts a big bid under the markets. And so if you think back to corn, 350 roughly might have been the average, national average cost of production. Well, corn prices went from roughly 350 to over 7, twice in the last 17 years. And so when you look at that, there's an opportunity in stage two to make money. Of course, stage three is when prices come back down as farmers continue to plant and supply catches back up with demand. And so that stage three prices come down. So we call that the golden grain cycle. Golden because if you understand it, you have the potential to profit from it. And using that framework, it's pretty clear to us now that we are in the stage one, where we're bouncing at or near, for soybean farmers, perhaps below the cost of production, which historically suggests that the downside is relatively limited. Which again would say, hey, if you have more than a 6 to 18 month time frame for your investment portfolio, now might not be a bad time to consider agriculture.
Well, there's always the buying the dip, and you just never know when it is. That's something we talk about. But I want to go. I want to examine this one, and I'm going to just make up four, because
Okay.
isn't stage four kind of wouldn't it be more of a we're in a stage four of the inputs have just
Mm.
I mean, the input rising with cost of production and what what you can get for that product are so much higher because of other factors of
Yep.
trade and tariffs and things like that. That might not be a natural cycle. So, are
That's a
we
good
still in
point.
a one, or are we making up a new phase here for?
Yeah, I think we're still in the one, but it's multidimensional. So the new one, that level is higher than it used to be.
Okay.
So for corn, instead of going back to a national average cost of production of 350, we might be, four and a quarter, somewhere in that nature. And we see this if you go back to 2006 with the RFS coming out 2007, the former cost of production for corn right around that $2, 250 in that range, we had a big step up. And so I think that what you're pointing out, Paul, is the multidimensional aspect of this, where the cost of production is not stagnant decade over decade. And here you go, because the cost of production is moving up, that baseline, if you will, is also moving up. And we have these charts on our website for anybody that's interested to look it up. It's under the golden grain cycle at tucrium.com. So you can check that out.
Sue Martin's getting really excited when you mention something like this. She loves a good phrase, the golden cycle there. But okay, again, Jake, your
Yeah.
perspective of your history, of
Mhm.
your previous life. Go get back in your LinkedIn profile of
Okay.
financials versus commodities. How complex are the two? I mean, agriculture gets this. Oh, it's simple. It's pretty much this, and then just as you were saying, it's very
Mhm.
complex. It's very much. How does the average investor navigate these complexities that all of these offer? Is the commodities easier to understand than, say, understanding who's making chips or who's selling whatever widgets to drive my stock price higher?
It's fascinating, Paul. I love that you brought this up, and the way you phrase it is perfect. So we also have an ETF in the crypto space, and I'm only mentioning that, okay, because recently crypto prices have come down, and money has been pouring into this crypto fund. Now, if you ask somebody to tell you what this fund does, I guarantee you they're not going to have any idea. They just know that it's crypto. It's a blockchain technology on a digital distribution ledger, right? That's so maybe the future of money, right? Okay. What is wheat? It's in your bagel, right? Like, hello, people. Wheat prices are down, but you're not buying the dip in wheat. And so, do folks really understand the complexities of what they're investing in? The answer is no. There is always that crowded trade that is trading the headlines, that is going to be trading, off of social media. The acronym is FOMO. There's the fear of missing out on the next big thing. And is wheat the next big thing? No, wheat's biblical. It's been around for thousands of years. But when you have the opportunity to sit down with a thoughtful allocator, which I happen to have those opportunities often, and that allocator is an investment advisor who's looking at strategically positioning their portfolio longer term. Those folks are going to take the time to learn about these markets, and they realize pretty quick it comes down to supply and demand.
Mm-hmm.
And when the government's open, we have this really great resource in the WASDE report that shows us that global supply and demand. Now, if you want to get fancy, you can get your own analysis and so forth and pay up for that. But that free report is the gold standard, and it's really not that complicated. And so, that's a story that we try to provide the education, and we do a lot of that through the website and newsletters and that sort of stuff. But it blows me away. More people seem to put their money where crypto is, as if they understand that, but not putting their money into wheat. It's interesting.
I'm going to have to now share this with one of my coworkers. A couple of them are huge crypto people. They love them.
Okay. All right.
I'm always getting texts of, did you see this? You should be buying this and this and this. They're looking at returns. They're looking at potentials. In a way, some of them are penny stocks
Mhm.
because they're so small, but they have this potential, or I guess the new phrase post 2020 was meme stocks. Is that what they
Yeah.
could do, right? Because they could just jump in ridiculousness in a matter of moments, and we just don't know why. Okay,
Yeah.
I mean, does it make any sense right now on
Yeah.
why people are interested in that?
Yeah, thank you. I appreciate that because obviously we have a fund out there for that. That ticker is XXRP. It's for the XRP Ripple coin. We wouldn't have issued that if we didn't believe in this space. And so while I can sit here and say, do people understand crypto better than they understand wheat? I don't know. We try to educate the audience,
Hmm.
on all the things so that they're making informed decisions. It just strikes me that when somebody buys the dip in digital coins but doesn't buy the dip in food, you scratch your head a little bit.
Right, I agree. But there's some people who are hesitant to buy a dip in commodities right now, corn, soybean, wheat, because they feel there's more negative news coming. You mentioned
Mhm.
China already. We're already looking at um, a ridiculous large crop. I'm not supposed to
Yeah,
say it out loud that yes, it's big. How big? It's different. I mean, that's people get ornery about when you start saying about things. But
yeah,
there's plenty of people who watch it, who grow it, who think, well, I think there's lower times ahead, so they don't think this is the dip.
yeah, and that's very possible, and that's why we say if you have a longer term time frame, call it 12 to 18 months or 6 to 18 months, from a portfolio allocation standpoint. What is your benefit to holding while prices move, let's say roughly sideways? And could you go down another 10%, another 20%? Well, sure. But if you're managing a portfolio, that's likely a rebalancing type of opportunity, right? You're going to rebalance your portfolio and buy your dip through the rebalance. And so that whole idea is what you get now is those potential diversification benefits with the historical precedent that prices typically shoot up, and they shoot up pretty quick. And so for anybody in the farm economy, you might not have seen 2020 coming or 2021, but by the way, in 2019 we had the flooding out in Iowa, of course, and we had corn prices pop up then. So there's also potential 20% moves while you're moving roughly sideways. And you never know. So it gives you that chance to rebalance your portfolio, scrape gains when they come, buy dips as they come as well, and then holding out for when there is a drought. And boy, I mean, looking at China buying nearly every bean that Brazil has to export, that just says to me, look, when the rain shuts off in Mato Grosso, what does that mean for soybeans? I mean, the world still needs American beans. You know,
Or a conversation goes sideways between the two countries, and then
yeah,
it throws the world's. I mean that's a fear I sometimes. I'm not sure that's a whisper or out loud. Is there's no reason to believe that Brazil and China are going to have an argument, but
hmm
that's something that could happen and could change dramatically, fundamentally change the way we look at the market right now.
yeah, and it's hard when we're in the throes of a trade war with China to imagine a world where China becomes our friend and starts buying every bean that we have to sell. Of course, we couldn't come near to meeting China's total bean demand the way that Brazil can. But you have to imagine that there are some buyers in China who get a little weak in the knees with a single source, supplier. But that said, too, Paul, looking at the balance sheet from September, there's another. If you take China out of the picture and forget about Brazil, 74 million metric tons of soybean exports. Soybean import demand. Right, the United States has 40 million metric tons plus, somewhere in that range. And otherwise, what do you have? You have Paraguay and Argentina. And, I mean, they're producing beans, but I don't know where the world gets that
Mhm.
additional 74 million metric tons. So, the storyline right now, I think, is accurate. Eventually, that business has to make its way to the United States. It means that there's pain in the near term, 100%. We saw what ADM did yesterday with their free deferred pricing program, right? I mean, these are things you don't typically see during a harvest. So there is near-term pain, yes. But again, that 6 to 18 month window, the world's going to look different.
Are those signals right now? The world news, is that the only signal we have on directions of markets?
I think your signals right now are the price charts. And the hope is that the price charts are more reflective of reality, not as much speculation, which could be the case simply given the absence of government reports. Um, some people might be sitting on the sidelines. And so who's actually trading these markets right now are the people who need the products, right? Or who are involved in the market. I don't know that that is the case. Um, Speculators certainly can read the price chart just like anybody else, and so they might simply be focusing more on the prices now too. But I'm just looking at the bean chart. Today it's looking okay. So we'll see if that's actually reality. Maybe we can get these beans back up to that 1050 spot. We'll
Well,
see.
we had the words were written yesterday by a couple of the analysts that we have on our program that said harvest low, or we're trying to set a harvest low. I mean, that's always the speculation. I mean, here it is. What would we say? The 21st of October seems a
hmm
little early, but the crop was early, and so maybe that means the low is early. I mean, those are weather signs too, I guess, that we're trying to watch. I don't know.
Yeah, and we particularly as it relates to corn. Obviously, there's a lot of issues that the farmers have been aware of and that people have been talking about for a while with southern rust and whatever other diseases we might have. Um, if the USDA puts out a November report, what's the likelihood that they're showing another reduction in yields there? Um, is that fundamentally bullish? I mean, we're still going to have a monster crop, yes, but boy, I mean, if we could ever see that balance sheet get under 2 billion on the corn carryout, I think that would be helpful. Now, does that come in January, or do we have to wait until September 2026 to actually see, what this year's crop was? I don't know, but I I do think it creates an interesting trading dynamic when the reports do start coming back out. Because if there is bullish news or bearish news, is it, hey, we haven't had any news, so we're going to sell the news? I'm not sure. So I would be wary of that. Watching prices move up higher, with the lack of data, be careful that prices might move back lower, even with bullish fundamental data later on.
It's hard to make sense. We've had a couple people try to say this is what happened when we had a 28-day shutdown, because that's what it
Yep.
looks like we're headed towards. Because by the time this comes out, we may or may not still be in a shutdown. We don't know.
Right.
But that's the part of commodities in general. We don't know. That's what makes it a speculative game. We
Yep.
know we have a good crop, or we know we don't have, but we don't know what everybody else has right now. So, I mean, that's part of this our best guess, and they just put your
Yeah.
shoulders up, right?
Our best guess, take the price is what the price is, regardless if it should be or not. So, if you're paying attention to all this stuff, but you have grain to sell, just have your pricing plan, your marketing plan in place, and watch the board, because that's what you got.
Let's go back real quick to the beginning, talking about Vermont, New York, Connecticut, and the people that are interested. I mean, help me understand on Wall Street. When I see traders, you're much closer to it. I'm sure you probably know people that have done it. How much do they pay attention to the rain in Iowa, the rust in Indiana, the drought in Ohio? I mean, what's just in an overall factor of what they're paying attention to? I know you can't speak to everybody, but just fill
Sure.
in some color for me in a photo.
So I'm going to break this down into two camps. One is the retail investor who would potentially buy one of our ETFs in their brokerage account. That person is probably getting most of their information through our newsletter and things that we put out, because we are the only shop that I'm aware of that has an interest in telling the story about American agriculture. We have products to sell: corn, wheat, soybeans. Great ticker symbols, by the way. Put in the sales plug: corn, ticker CORN. And so we have a vested interest in telling the story. We do keep it higher level: the golden grain cycle, supply and demand, WASDE, the fundamentals. That's one camp, okay? And those folks will be interested when we write about the weather. Let's say, okay, it's raining or not. The other camp, when you think about New York and Connecticut and Wall Street, are the hedge funds. And we were down at the Greenwich Economic Forum a couple of weeks ago, and Ray Dalio is a big speaker there, and we're in hedge fund capital of America, basically. And I will tell you, there are firms who are very quiet. You would never know who they are, that pay a lot of money for advanced data and information that goes beyond what we're writing about. And those are the true spec commodity trading houses that are in the markets every day. And so that audience exists. It's not typically our audience, but there are people with whom we rub elbows in that world.
Why are they important?
They are the speculators. They're adding liquidity to the market, and you can get upset when you look at the COT reports and you're seeing somebody's long, somebody's short. These are the traders who are laying into those positions, and the funds. When you look at the funds, those are really the ones to think of. We're very transparent. Go to our website. You can see the value of the dollar amount in our long only funds any given day. But these hedge fund speculators, these are the funds that are in the market, moving things short, moving things high. They're the big traders, but that liquidity is helpful. That liquidity is helpful. And that's the role they play.
Because I'll get notes from farmers who are just like, get them speculators out. And then the response is, yes, but they're the ones helping drive up the price.
And drive up the price and sometimes drive down the price. And depending where you sit in the farm economy, either one of those things is going to help you more than not, at a different time and place. And so it's really about the liquidity that they add. A buyer and seller on the other side. If it was just the farmer and the commercial, well, you're going to be complaining about the farmer or the commercial, right? Here's a third player that comes in, and in the best case of the free market world with all the information available to everybody, they're helping keep the market true, right? They're helping bring the fundamental reality to the market. Now, they are going to lean heavy one way or another to play the trend, and you have these things called blow off tops, and the bottom falls out, and all these things, and there's never, quote, the perfect price, but the price is always what it is, and it's the benefit of the liquidity as that third party in there.
And it gives us a little bit of understanding and guidance of what's maybe happening at this exact moment when there isn't a government to be issuing reports.
100%. And there have been times when I've seen futures on wheat prices spike up, and I go, what the heck was that all about? And then I get the report the next day that, wow, there was a big drought report coming out of Russia. Well, I didn't have that information, on my desk, but prices reacted to it. So oftentimes the markets are going to move before the narrative catches up. And that narrative is usually what moves the market just among the people that are paying for the information.
And to take that another step further is then there's those who think we don't need the government reports, period. We can rely on private estimates or weather reports or private companies. But then it goes back to the very beginning of what you had talked about, why that information was created, why USDA was created, was to help the farmer have the information. If that goes away, we don't have, I don't know if balance is the right word, but it's at least a factor.
Yeah, without a gold standard in the WASDE report, for example, I think you have a lot more volatility in these markets, and the opportunity for bad actors to do things that they otherwise can't do when everybody can see the WASDE report. And that is a good thing about having USDA data 100%, even the weekly export sales. This is It is there for a reason, and it's there for a good reason. One of those reasons, by the way, is so that Russia doesn't have a great grain robbery 2.0, right? So,
You are
I mean,
familiar with the show. You are familiar with Sue
oh,
Martin when she talks about this. Then you've got it, Jake.
well, the great. I mean, what a wonderful period of history to learn from. Holy cow! But yeah, so no, it's very important.
Would we ever get a signal that that's happening again?
Well, if everybody's playing by the rules, it should be very improbable that that could ever happen again. Um, yeah, I can't see how it would be possible within an open government
Yeah.
and all the reporting mechanisms we have in place.
Okay. Jake, I appreciate it. This is kind of fun. I enjoy the because to me, I think a different view. I mean, it's a higher view. I know the people that are in these cornfields and bean fields, and they can. It's hard to see past that row. The larger picture is sometimes they wonder why is anybody in Vermont, Connecticut, California, Washington care about what's going on there, but they do.
They absolutely do. And I would say for those that are local too, I just looked at something, some information we have on financial advisors. In the greater Des Moines area, the top 20 investment advisors are managing $123 billion. Okay. So this is in Des Moines. 1% of that, call it $1.23 billion allocated to soybeans, that adds liquidity to the soybean market, right? And so, you leave it to folks to make their own decision if they want to be long. But if China is not buying American soybeans, we have the opportunity to do that and add liquidity to that market. So folks like the farmer I was talking about that was selling the March contract has that liquidity. So it's a big world out there, and there's a lot of money.
Jake, thank you.
Pleasure. Thank you.
Our production team is led by Sean Ingracia, David Feingold, Reed Denker, Neil Kyer, Kevin Rivers, Julie Knudsen. As always, thank you to making this podcast possible. Our executive producer of Market to Market is David Miller. I'm Paul Yeager. We'll see you next time. Bye-bye.